Thank you for joining the Future of Finance Fund Accounting webinar today, and a special thank you to Apex Group for their sponsorship of this discussion. I shall now pass you over to Dominic Hobson.
Other counterparties are repeatedly exposed, most recently in the Wirecard fraud. Plenty of funds were invested in Wirecard stock. It was, after all, in the leading DAX index. And fund accountants rely on prices taken from stock exchanges such as Deutsche Börse every working day. Now, triple entry bookkeeping facilitated by blockchain can in theory make frauds such as Wirecard impossible. But the impact of blockchain on fund accounting might be even more direct than that. Blockchain platforms or blockchain networks accommodate not just cryptocurrencies, but tokens representing securities or other assets, digital assets, stable coins, utility coins, payment coins. Perhaps one day soon, as a recent Future of Finance webinar pondered, central bank digital currencies. And if illiquid assets are digitized and they're invested in by funds and they become liquid, fund accountants will have to widen the range of pricing sources they use. And the potential effects don't stop there. Blockchain might make fund accounting more transparent, it might automate NAV calculation, and if it does either of those things, what will fund accountants do then? To help us answer these and other questions, I'm joined by 5 people who know a lot more about this subject than I do. David Barry is Global Head of Hedge Fund Products at Apex Group, international fund administration business that provides management company, depository banking, brokerage and FX services, as well as fund accounting and investor services. And Apex is the sponsor of our webinar today. Giles Sayers is a due diligence analyst at Allborn Partners, the investment consultancy that specializes in research-based advice for investors in hedge funds and private equity, but which also specializes in advising investors on operational risks, such as outsourced fund administration services. Frank Walczak is Global Director of Business Development at Invenium Capital Partners, which specializes in real-time pricing of digitized assets issued on blockchain and other platforms, including illiquid asset classes such as real estate in both the primary and the secondary markets. Richard Perry is a partner at Simmons & Simmons, where he specializes in the structuring of alternative investment funds and hedge funds in particular. Unfortunately, our 5th and final panelist is not able to be with us today. Dr. Sean Stein-Smith, an investment professor at the City University of New York, where he teaches the courses in accounting and economics and business and specializes in the study of the impact of blockchain on these professions. And he works also, advises the advisory board of the Wall Street Blockchain Alliance. Unfortunately, Dr. Stein-Smith fell ill yesterday and won't be joining us. We obviously wish him a speedy recovery. Now, in addition to our panelists, we do of course also have you, our audience, as well. And everybody watching or listening is free, indeed expected, to submit questions at any time to any or all of our panelists. All you need to do is use the Q&A functionality. I prefer you use that to using the chat, but you can use the chat if you wish. It's at the bottom of your Zoom screen, and you can direct your questions to all members of the panel or to a specific member of the panel, and you can do it by disclosing who you are or anonymously if you prefer. Unlike most webinars, we won't be saving up those questions to the end, but we'll address them as we go along, so please do get involved. As at any Future of Finance event, we do like it if everybody is part of the discussion. But let's begin by asking, if fund accounting is going to be disrupted, what exactly is it going to be disrupted by in terms of technology? A lot of money is on blockchain. Perhaps they're wrong. Could it be AI and machine learning? Could it be big data? Or could it be something much more familiar? Perhaps I can begin with you, David. How are you using technologies such as blockchain, AI, machine learning inside your day-to-day business? And perhaps you have some observations as well on less exciting, less forward-looking technologies and what impact they're actually having on your ability to calculate NAVs.
Yeah, thank you, Dominic, and welcome everybody. I think just to put in context as well, when we refer to big data, I'm amazed how much data we have to collect as an independent administrator across every fund. We start with the PPMs, the legal documents, constitutional documents, broker information, IM agreements, admin agreements. Then we move into the trade captures, so the trade blotters from the managers, broker statements, and the list goes on. We speak about investors and the amount of additional information we now have to capture with investors, from KYC to AML to FACTA, CRS, Form PF. It's amazing how much the requirement for data has really evolved over the number of years. And to be able to manage that as a group across multiple applications, we need the use of technology to be able to streamline those processes, be able to manage the data, be able to use that data, analyze that data, cut and slice that data. So technology has proved a really important aspect of being able to do that. And I think to give a couple of examples is probably the best way to show how we're using these technologies to just better improve how we do things. So perfect example was that I needed to search if we were a valuation agent across all our agreements. Which, as you can imagine, across 3,000 funds, that was quite a lengthy task. So we've centralized all our documents in legal, and I reached out to legal and said, can you tell me if there's any funds that were valuation agents? And I think the answer I would have got 10 years ago was, oh, this is a big task. This is going to take me weeks, right? The response I got back was it was fantastic. Was, yeah, we can do that, Dave. Yeah, we use an AI tool to help analyze that subject matter, and yeah, we should be able to get back to you in the next couple of hours. I was like, okay, wasn't really expecting that answer. So, I mean, this is a really good example of how we're using AI to just help search data, and I think the premise is that we need that information sooner rather than later, right? We need data real time and as soon as possible. If in terms of blockchain, yeah, I think it's obviously I sit here in Malta, and they've been a big promoter of blockchain in terms of technology. Probably haven't seen the levels of disruption that were maybe talked about a year and a year and a half ago, if not 2 years ago, if not more. But we are seeing it becoming, dare I say, being involved in new technologies. And the perfect example is that we're working with a group in New York, quite a large tech firm in New York called Triple Point Liquidity, who are helping us build a digital onboarding for investors. Again, this is using technology to look at a very manual, labor-intensive process, and they're using blockchain in the background to be able to do that. And effectively, they're creating what we would say is almost like a digital identity or digital ID for those LPs, without compromising any of the controls and procedures that we need to do as an administrator. The fundamentals remain the same. I think it's very important that checks and balances are still there, but utilizing the technology that's available to really streamline those operational. Again, making life so much easier both for the LP, for the GP, and us as administrators. So two examples on where we're using AI and blockchain in technology and projects that we're moving forward in the Apex organization.
Thank you, David. Now, Giles, I'll come to you in a minute to get an investor perspective on that onboarding process that David has described. But perhaps I'd come to you first, Frank. You come at this from a different perspective. You're using Ethereum. Perhaps tell us a little bit about exactly what you're using it for and how you think this will affect the fund accounting business over the next year or two.
We use Ethereum to hash data to the chain, to create an immutable record of whether it's an accounting piece for a fund, of whether it's the legal piece that David was talking about, such as the PPMs and all those different records that go along in the process with the process. We use Ethereum because it's a public chain, so people can search, and they can search publicly to see where things were hashed, and they can't see exactly what was hashed unless unless they're given an identity to go in to search that deep. We use what Invenium Capital does. We're concerned with data integrity for price discovery. And we basically are centered around illiquid, infrequently traded assets. So basically commercial real estate is where we're starting, but we're moving into private credit and private equity as well. So the chain is really used to, for these, and I think Giles will probably touch on this, hard to value private assets. So what we can do is we can go through and do that first valuation. We can create a digital representation of ownership of that asset. And then we can attach that valuation to the actual asset. And then we can keep seasoning that asset through periodic audits of all the information that's evolved around that asset. When it comes to commercial real estate, it would be financial, legal, operational, and experiential. And we do these periodic audits, and then we can attach them to the representation of ownership. So when you digitize an asset, you're just creating a representation of ownership, but what we're doing is we're attaching data that has been digitally certified. It's been indexed and fielded, so it's searchable, and then it's validated through a very simple AI 2 sigma in range, outer range for that asset to comparable assets. And then that can be attributed to a sophisticated model to come up with a fair market value pricing. So we're doing this with real estate right now. And through that process, well, to get back to your question, Dominic, that's where we're using Ethereum. We're taking all of that data that we're generating and then we digitally certify it, and then we don't attach all of that data to Ethereum, but we hash it, and then that hash is a pointer to a whether it's a private data bank, your data bank, whether it's an Invenium data bank, but it's basically a deal room where you can go and you can look and you can see all those periodic audits as we go on. So as what we think is this is going to create a more automated, more truer representation of the financial, legal, experiential, and operational information data from that asset. And you know what David was talking about, the amount of data that can be collected, it's really incredible, the amount of data that's out there. But what's important is making that data, is indexing that data and fielding it so it's searchable and it can be used to be compared against like or different assets.
Would it be fair to say, Frank, that you're automating a process, but you're also making fair valuations fairer, truer, more accurate through time? Is that a reasonable summary?
That is a reasonable summary, and the reason is for that is because we're informing that digital asset, and we're informing that of the actual data that's coming off of the asset, right? And we try to do that. We're getting to real time. In your introduction, you said we're doing real time pricing. We want to get there. On real estate right now, we're doing it monthly, where we have our monthly prices are US PAP compliant. And we're working to get to weekly, and then we'll probably get to daily. But as far as real estate's concerned, we're not sure if we're going to need to get to daily, because there's really not that much that changes on an asset like that.
Okay, Giles, you've heard David explain how he's using AI to search documents more thoroughly and throwing up things which will be of interest to you as an advisor to investors, like who is the valuation agent for this particular asset. You've also heard David describe how investors can, certainly into funds that are being administered by Apex, can join with less time and trouble with the AML, KYC, sanction screening checks. And you've also heard Frank explain how the accuracy of the valuation of illiquid assets inside funds can be improved using blockchain technology. It sounds like a lot of good news for you. But am I putting words into your mouth by saying that?
Well, I think there's I guess 2 or 3 different things. I think in general, you know, from just to answer, I guess, you know, from what David was talking about first. So, yeah, I mean, it's obviously a really good initiative which in some ways brings down costs, across the board. I think there's also, from more of a risk point of view, there's obviously, there has to be controls there. I think that, when if you're essentially doing AML and KYC procedures, and then, say one party was doing those, then you could, I guess, essentially then move those on to somebody else where they would then not have to be done. I think that there's possibly some control issues around, the unique kind of investor profile, from a data protection point of view. And I guess these are things that haven't really been seen before. So, but I think, it's definitely manageable down the line. It's just, it's sometimes with a lot of risks, you kind of, look at them off over a certain period of time, and then you build up more of a risk bank of things which are, commonly seen, I think. So, I think, with any kind of new technology, so to speak, and any kind of new initiatives that are brought in, there will be control issues or new things to look at from a risk point of view, but it can also streamline the process at the same time. I think the other point, about valuations, I think it's a tricky one, because I think, especially on sort of more private types of valuations, some, as Frank was mentioning, with things like, commercial property, for example, you can only value things based on how frequently you get the underlying inputs. So, if you were getting the inputs in monthly, you can only really, generate a valuation monthly. You could generate it sooner, but it's probably not going to really be of much interest if the inputs haven't changed. So, if there's a way to, I guess, kind of speed up the how frequently you can get those inputs into the valuation process, then sure. And I think you could use the technology definitely to drive the underlying models which actually create those valuations, right? I think that's probably where the main benefit comes in. But then once again, you have to look at, I guess, what those models are actually spitting out at the end of the day. It's obviously taking information in, and you need to look at what the model's doing and then what it's churning out. So once again, from a control perspective, that's also something that would need to be looked at from a risk point of view as well.
Richard,
Yeah, sorry, just on that, George, you touched on some really good points there, and I think it potentially leads to why maybe blockchain hasn't had the impact that everybody thought it would have, is around regulations as well. Right? We're really constrained with regulations and what we can do. And I think it's a very, very important point. We talk about risk a little bit, but to me, it's certainly around the regulatory constraints that we have, particularly maybe in Europe, where we see it's a lot more regulated. A lot of these initiatives are probably hidden in other regions. Like, we're doing this predominantly in the US for GPs and LPs. We're seeing a similar kind of appetite in Australia, again, based on local rules and regulations. And I think that's a really, really valid point that has to be considered. As I mentioned, our requirements don't change, right? We still have to fulfill our checklist. We still have to make sure we have all the appropriate KYC and AML documentation. But we're now maybe looking at doing it in a much more efficient way. And,
exactly, yeah.
And also, for the benefit of the investor. The example you said was perfect. Like, once we have verified the data from the investor and they invest in another fund that is administrated by Apex, we can share the data and say, yeah, look, it's already been verified by Apex compliance or Apex group, right? And I think that just adds a real value to the investor. Because,
well, I think there's also something to be said, like your point there is, there's generally something to be said about, who initially does those AML checks then becomes the reputable, party who's actually doing that. And then it's, I guess, then a question from a control point of view is, are they a reputable? Is there a reputable party that's done those checks initially, right? But then you have complications as to, finding out who that is, and so it obviously brings up further complications, but
exactly. But as
these
I
things
said,
have a way of sorting themselves out as well, right? So.
Exactly, and we keep it internal, right? This is all for Apex internal administrated funds, and we touched on a point around data, and at the end of the day, it's the LP's data, right? He can decide, he or she can decide who gets that data, and then you make another very valid point, and it's up to that recipient of that information to say, okay, we trust the verification element of this, right? But for us, it's all about making sure that we continue with our checks, but then, just making the whole user experience, the whole take on and onboarding experience just better for the end investor.
I don't want to be a party pooper here, but this is a webinar about fund accounting, not investor relations and transfer agency. It's interesting to hear that blockchain can have that effect on what's a very tiresome process for investors, which they experience repeatedly. And I think we perhaps need another webinar on that whole subject very soon. But Richard, perhaps I could just bring you in very quickly and ask you to what extent technology, and particularly the new valuation techniques which Frank was describing, and which are made possible through the digitisation of assets in general, to what extent are those finding their way into documentation, into PPMs these days? Are they?
So, so I followed the question. Yeah, so actually, I think fund documentation is not changing so much at the moment. And the reason for that, and there's a good reason for that, I think, which is that the fund documentation tends to describe broad principles that are going to be applied in relation to different asset classes, but leaves the sort of more granular detail of valuation policies to a valuation policy document, which for European managers, the AIFM is required to create, so the manager of the alternative investment fund. And in practice, we'll get it approved by the board of a corporate fund as well. And I think that's better than putting that into the actual fund offering memorandum or prospectus, because it allows it to be the valuation policy is a more organic document. It allows you to change pricing sources. So, Frank's business can become a pricing source for a real estate asset within the fund, and that can change on an annual basis every time there's an annual review or more frequent review of the valuation policy. So I'm not seeing major changes there, and actually my general impression is I'm not seeing a lot of investor comment on those section of hedge fund offering documents in particular, although there is investor interest clearly in how level 3 assets in particular are going to be valued by a fund.
Now, both David and Giles brought up the question of trust. I just wonder if you could just quickly cut to the chase here and dispose of one issue. Blockchain is an accounting technology, and because it's an accounting technology, it can in theory disrupt fund accounting like any other form of accounting. And it will do that because it can capture every transaction, in this case, subscriptions, redemptions, switches, expenses, income, and so on. It also theoretically disposes of the need to reconcile between the custodian bank and the asset manager. Theoretically, it gets rid of the need for you, David, as a trusted intermediary. But does blockchain solve the question of trust? Can you trust the information which is there in the distributed ledger or not? Has Apex formed a view on that?
Yeah, I mean, it's a great question, and it's kind of what a lot of the industry see blockchain as being somewhat. There's an argument whether it's transparent, but it's when it's in the ledger is final, right? And I don't want to say gospel, but there's still the need to keep proper broken records, right? I think that's one of the areas that blockchain just doesn't do, right? It's having that audit trail per se, not necessarily audit trail, but the proper books and records, right? And it does maybe lead to a question around verification, right? How is the information in the ledger verified, right? And I think that's something that Giles touched on as we talked about the LP onboarding. But I mean, there's an element of yes, there is an element of trust, but it's also a new technology.
and people are still, maybe like myself, I'm old fashioned, where you're used to the physical element of it, right? These are all digital ledgers that takes a lot of time for people maybe to understand the technology, maybe trust the technology. But I can understand your point of view in terms of how it can potentially disrupt. I just think maybe that we're not quite there yet in terms of that trustworthiness. That there's still a constant need for that physical books and records.
Mm-hmm. Thank you, David.
Right. And I think part of that trust is the education about the technology, and also because of the technology came to light around the cryptocurrencies. And when that was going on, that created a lot of nefarious actions. And there was a lot of bad stuff going on where people were creating a bunch of dog coins or, crap coins. I could use another word, but, and so that has created a basic shield on not only on the cryptocurrency world, but on the blockchain technology itself, where people, if the education is so important around the actual technology, that's the underlying technology of these cryptocurrencies, but its applications in other places. And David, to what you're saying is, you'll still have a double entry book and entry for accounting, but that double entry book can be then hashed to the blockchain. So sometimes when anybody goes to reopen that book to add something else to it, right, you can run an algorithm across that to make sure that document has not changed. And if anything, if anything is changed within that document from the last time you went in or anybody else went in, and there can be a record of who's been in and out of that document, you can tell if anything else has been changed. If a pixel on that image of that document or on that JSON file, anything has been changed on that document, you'll know immediately, right? So it's not the actual triple ledger accounting in a triple entry form. It can still be a double entry form, but if that can be hashed to the blockchain, then that is where you can create that trustless views around that document. And that, I think, touches on what Giles was talking about. There is an element of risk with everywhere. So it's only as good as, David, if you're putting those entries in that document, it's only as good as the entries you're putting in. All we know is those are the entries you put in. So we got to verify, you have to go back and verify who is David and was he putting in the right numbers. But if they weren't the right numbers and it drills down that it was you, then that way you can get right to the source that way.
We've had a question here, which I'm not sure who I should put this to, but it's from Amit Kumar. It's, how can we make blockchain understandable and usable for 99% of developers, and at the same time invisible to end users?
Well, the way around that is, obviously to create more courses for developers to learn blockchain and to get more of a standardized language and library around the actual coding of that chain. And then the other reason is to make it in the background to the end users is to have a value proposition that blockchain is creating. So through the process that we're doing with commercial real estate, through the Invenium.io platform, where we gather data, we digitally certify it, we index it and field it so it's searchable, and then we validate it, and then we can apply it to a model. What this has the capability of doing is changing the way an asset sits on an owner's balance sheet. If it's a public company, or like say an insurance company or a bank holding company, we can actually change, according to GAAP accounting rules, we can actually change the way that this asset sits on somebody's balance sheet. So the reserve requirements around that asset will change, so we can free up capital on somebody's balance sheet. So that is something where when we're talking to potential clients and we're talking to potential customers, we're not really talking about blockchain. We're just talking about the value that we can add, to that user, to that asset owner. So to answer your question, it has to create a value for the user and not just be blockchain for blockchain. Like, blockchain is not a use case everywhere, and people use it as a keyword, a flash word. Like, yeah, we're using blockchain. We're doing this, but there's certain areas. I used to keep a thing on my desk say, does this really require blockchain? And to really think about it, am I just trying to push blockchain in there to be forward thinking and to move this forward in that realm, or does it really have a value application? Is it added value? Or am I creating value for someone? In certain cases around these types of assets, we're actually creating value for certain customers.
Now, Giles, you've heard Frank say that the value he is creating is actually capital saving. But can I ask you, you would have heard Richard also say that valuation policies appear in sort of broad brush terms inside these documents. So investors are investing in these funds without really taking that much interest in the absolute detail of valuation policies. How much do investors care about valuation policy? And I'm talking here really, I guess, of the less liquid types of assets, the private credit, the real estate, the venture capital funds. Do they get into the weeds of understanding how the assets which they're going to be owning are valued?
Yeah, so as you said, I think with a lot of funds, which I guess are more liquid by nature, they're, where they tend to have sort of level 1 and level 2 assets, there tends not to be as much scrutiny there because there is an available price usually, and there's quite a, I guess, generic valuation policy at more of a, I guess, manager group level, and it's quite uniform. It obviously applies to, I guess, other funds that they might have on their platform. But yeah, as you said, there is I think some investors that care about it, from a definitely more on private markets funds than some other investors. I think certain investors are just concerned with different things from a risk point of view, and I guess the ones which are concerned about valuation, they might look at their valuation policy and look, word for word what's actually in there, if there's kind of discretion in the process, what types of models are they using. I think there's definitely a lot of concerns as to quite often as to whether they're using valuation agents. There's an independent sort of verification there, and then some others are just maybe a bit more concerned that I guess it's in line with what other managers within that kind of asset class are doing. I think a lot of them kind of view it as if they're doing what other ones are doing, then it's generally going to be viewed as okay. So, from that point of view, I think that's kind of the sort
okay.
of.
Thank you, Giles. That's very helpful. There are a couple of other questions here. A quick one really for you, David. And I think you've kind of answered this. It's on which fund administration task are you using AI or machine learning today? I think it was reading documents was the answer, no?
Yeah, no, we've used that for to read through or the number of huge amount of documents that we have. We actually are using AI for another particular project that we're utilizing, which is again around actual digital onboarding. But we've launched a product in our banking sector where we effectively can open a bank account online within days rather than weeks. And I think, I was going to touch on this around just the kind of how technology has really improved efficiencies. And you look at a process that over the years was just so labor intensive. I mean, the difficulty we now in having open a bank account, right? It's the amount of documentation that we need, the amount of CRS forms, it's a very kind of paper processing, and a challenge, right? I think everyone can allude to that at some point. But what we've seen over the number of years is the likes of, you know, the Revolut, where, you know, setting up creating a bank account is just, you know, should be seamless. And we've developed basically a digital onboarding for a bank account within EDB. We use actually AI technology to actually verify the documents. So it's a full open source technology using APIs across multiple sources. And it's, again, you know, really a solid and a good example of how technology has just really improved how we do things, and really to the benefit of the end user. And I think that's the important part, right? Is that, you know, anyone on this call can easily set up a bank account within days now, you know, and paperless. There's no paper documents needed. You know, we walk you through how we take a selfie of ourselves and we upload our passport, and there you go, we have a bank account, you know, and then the efficiencies around that, and then the platform and the payment platforms that we can integrate through this. So your bank account opening is one way in which, another example of how we're using technology, particularly AI, as well as open source technology, to again, you know, take a really, what traditionally has been a long process into a few days process, and hopefully a very slick, efficient and user-friendly experience.
Certainly, I'm hearing, David, that technology is making your business a lot more efficient, hopefully lots more profitable too.
We hope.
I have a question. Another question's come in from Saurabh Saxena. I'd like to put this to you, Richard, in an odd way. The question is this: financial instruments like CDS played a major role in the 2008 crisis. With the use of blockchain, can we expect to see more such financial instruments in the future? I think we're being asked whether this technology makes financial complexity easier to execute. Are you seeing managers pushing the envelope in terms of fund structures and digitized investment instruments, or are we still staying within a relatively conventional territory?
I don't think we're seeing a huge amount of innovation on fund structures. Whether it's mutual funds or hedge funds or private funds, I mean, by and large, I think managers want to give investors what they're used to seeing, and are not particularly innovating on the fund structure. But I think the question was more from the listener, was probably more about the assets, yes. The instruments that are being created. And well, I think there is, you know, tokenization and its equivalent. I think there is the ability to create more layers of derivative instrument. And then the question there is are we creating complexity that will create the next, you know, the conditions for the next global financial crisis? You know, as long as these are transparent instruments where the data is good, and investors are capable of analyzing what it is they get ownership to, then I'd like to think not.
Does the regulation insist that that regulated funds invest in regulated instruments traded through regulated brokers on regulated exchanges?
Yes. So, you know, as a sweeping generalization, sort of global regulation. Yes, funds that are sold to, you know, mutual funds, funds that are sold to retail investors have, you know, highly regulated investment universe that they're permitted to invest in. So the exotic asset is more for the alternative investment fund.
Thank you, Richard. I'd like now just to turn to an area we haven't really talked about with technology, which is speed. Theoretically, these technologies will make it possible to create such a thing as a real-time or near real-time net asset value. And David, perhaps I'll come to you first about this. Who wants such a thing? Do investors want it? Do managers want it? And what does it look like anyway? Is it even possible?
Yeah, no, I mean, I think there's just a general need for information sooner rather than later, right? Everybody wants information yesterday, and certainly, the technology side has helped, be able to extract that information from the data set. I think that's certainly a given. I think when you talk about real-time NAVs, I think, and it's a fundamental part of valuations, is around the liquidity we're offering to managers. Why do a real-time NAV if you can't deal on it and you can't have the liquidity to investors? Because with the technology that managers have and portfolio managers have, they have this data already, right? They know what their portfolio is doing. So without the kind of real-time liquidity, I don't really see where the add value is, right? Because managers know this, right? They know what their positions are doing, what their portfolio is doing, the various risk measures. However, we have seen a more of a push for daily P&L or gross P&L or enhanced reporting around and greater analytics around portfolios, predominantly due maybe to the volatility that exists in markets. I mean, we're seeing double-digit spikes on pure equity markets, right? It's been a pretty much a roller coaster since mid-March, and managers just like it, to have that available to investors, verified by an independent party, to give that data in an environment that's a little bit kind of. They were concerned. Investors are concerned. They're worried, right? They said, what's my portfolio doing now today? I see Apple's up 10% or down 20%, right? So, it's really just to meet investor demand, really. And if there is a need and a demand from the investor for more frequent NAVs or more frequent analytics, then the manager will certainly reach out to us. But real time intraday NAVs, obviously something technology and something we can do, but I think just without offering the liquidity terms to investors, I really don't see the add value to investors.
But isn't that but David, wouldn't you think that would be the first step towards that liquidity, offering that liquidity, is having that NAV and being able to socialize that data? Yeah, right. So you're talking about there's no need for it without having the liquidity, but that is really one of the steps towards creating that type of liquidity. I know it is in these illiquid markets because, you have a lot of companies that have come around, these tokenization companies that come around, and just because something can be fractionalized and can be distributed doesn't mean that automatically is gonna create liquidity, because people need to be able to make intelligent decisions surrounding an investment, and they can't do that unless they have that data. So we were talking about touching on that earlier, having that data and being able to trust that data. Like, the only way a big office building, we think down the road, 10 years, 5 years from now, maybe 10 years from now, I'm going to be able to buy a building from Richard Perry and be able to sell it to you, David, on the same day. And the only way that that's going to happen is if we both trust Richard Perry's data, right? So those and have a fair market value that goes along with that data. So I think the NAV price, you may be right. We don't need it daily, but or we don't need it real time. But creating that NAV and being able to socialize all of that data surrounding that NAV is what really is that step towards the liquidity. Now, every manager knows what's in their portfolio, right? But if he wants to sell that portfolio, now he's got to let somebody else know what's in that portfolio. And if that go ahead, Richard, you wanted to say something?
Yeah, well, a thought was, and it's sort of an adjacent thought to the one you're making there, Frank. Just I think the multiple NAV calculations within the same day, I don't quite see the need for, but I could see that investors in hedge funds, for example, where typical terms are monthly or quarterly redemption frequency. They're only getting monthly NAV reported to them, and so the point that you were making, Frank, was that they can only make a decision to make an additional investment into that fund or to redeem from the fund based on the sort of monthly information that they are provided. But I could see that if technology allows NAVs to be reduced much more easily, then there could be much more investor demand for daily NAV information, so that they can make their decision to redeem promptly, rather than having to wait to the end of the month to decide whether they're going to decide to submit their 90-day notice.
And that's exactly what I mentioned, that particularly around COVID, because of the volatility, that's a product and a service that we were offering that became very popular. You're 100% right, Frank, and it's the real principle around data is being able to have it at your disposal when you want it and when you need it, right? And technology is really helpful for that. So one of the big kind of offerings that we have is a kind of basically a daily P&L on your portfolio, plus enhanced risk and reporting around it, right? So investors, when they're a little bit concerned or a little bit worried about where their investment is right now, and as Richard said, maybe we don't give them an official NAV till the middle of the next month, and they're like, it's kind of too late, right? Because with what we've seen in the volatility, that could be down 15% and it's too late for them, right? So I do think there's definitely a need for more and timely information. And again, if there's an investor demand for that, and the investor or the manager is willing to share that, then I 100% agree. I think there's definitely an investor. We've seen it over the last number of months. Definitely an investor demand for more regular updates on where their position and investment stands.
Let's ask Giles, get an investor view. We've been discussing here with the three other panelists, really, what's the chicken and what's the egg? Who needs real-time NAVs, and you don't have real-time liquidity if you can't have real-time liquidity without real-time NAVs? Do investors want real-time NAVs, as opposed to what David was describing there, just a check on the portfolio in terms of volatility?
I'm not sure whether investors really, I guess it really depends on the investor and what types, what asset classes and strategies they're investing in. I think, I think Richard made a good point, from the hedge fund side. There's a difference between reporting a NAV daily or twice daily. And I think a lot of investors are going to welcome that type of frequent reporting. My only thing is that, and what we see, I guess, quite a lot in hedge funds, is that just because you have the liquidity in the portfolio, it doesn't mean that the investment manager wants to run his portfolio in that way. So, and it's not necessarily good for the investor if there are investors coming out all the time and going in as well. So, there are definitely hedge funds that have tons of liquidity, and they could run a daily fund, but there's still only monthly subscriptions and redemptions, or sometimes even quarterly. And the reason is because it's a buy and hold strategy generally, and they want to run the portfolio like that. So it's there might be investor demand for a strategy like that, but then they'll have to find an investment manager that actually does that strategy, if that makes sense. So it's not just about the liquidity per se.
Now, you might be surprised though, we've only got 10 minutes left, and so time does fly in these webinars. Could we just talk a little bit now about maybe some of the longer term consequences of technological disruption? And one thought that occurred to me, and I don't know whether you have a view on this, Richard, is that I've been around long enough to remember the market timing scandal back in 2003.
Yeah, me too.
Which resulted in a lot of asset managers being fined large amounts of money by regulators in the United States. And I wondered if changes in NAV frequency either increase or reduce the risk of something similar happening. My thought was maybe it increases it.
Interesting question.
Well, the market timing is an interesting question. The market timing story of the early 2000s. There were two things going on at the same time, wasn't there? That the SEC were challenging at the same time. One was late trading, where subscriptions were allowed were accepted sort of after the valuation point, when they knew what the market had done, but it was a historic price. But the market timing one was more about Asian and European stocks where the market had shut, but there was market news that was going to cause those prices to rise, or there was thinly traded stocks, so there hadn't been a trade that had moved the price, but there was market news that was going to move it, and investors were buying into those mutual funds, sort of to capture the profit with extra information. Maybe I'm not thinking about this hard enough, but if you have more valuations within the day, if the market shut in Asia, the market shut in Asia, it doesn't really sort of solve that problem. I think just a sort of different point I'd make about a sort of practical reservation there might be about having a sort of multiplicity of valuation points, certainly for European managers, is the AIFM has regulatory responsibility for these valuations, and although technology can improve the accuracy of the valuations, I think the more you do, I think the more chance there is of getting something wrong. I still think there's always going to be some human element in these calculations. You've got subtle items like share classes where some P&L is allocated to it, or an accrual for a complicated performance fee that needs to be checked against the offering documentation. So tech has got the solution to many of these things, but I just think you can make the same mistake several times and have lots of liability for the manager as a result. So I think there is a sort of legal reason why you might want to sort of limit the number you create, the valuations you do.
Okay. Can we talk about something else now, which is the question of custody? If say we move to tokenized markets, digitized markets, one of the problems that arose with the cryptocurrencies, which were the first into the field here, the ICOs, was that they were in effect a series of thefts because there was no independent custody function. Giles, how alive are investors to that risk? Are they demanding independent custodians as well as independent valuation agents before they look at that asset class?
Once again, it also varies, and I think it also varies by, once again, how whether you're looking at level 1, 2, and 3 assets. I think generally custodians are seen across the board and a good thing. Just I guess putting valuation agents aside, I think from the digital assets point of view, I think it's probably a little bit different in the way that the custodians are not your usual players in the market, really. So if they're a bit more unique to that asset specifically, that might be a concern for some investors. Doesn't mean that they won't invest, but it's definitely something that they would possibly want looked at. And I think I think one of the concerns with this kind of growth and rise of digital assets generally has been the security around like private keys and which are unique to that investor. And I think once those keys are lost, I think as far as I know, it's pretty much irrecoverable, right? So I think there's definitely a heightened security issue there. So that would definitely be a new risk, for example. And then, like I said, I think you'd also have to look at which custodians are actually tasked with holding these things, and are they reputable? How many people are there in those businesses? But over time, it's like anything. You tend to have those parties get bigger and bigger the larger they're in the market, right? So.
And Giles, there are some investors who won't touch crypto for those.
Yeah, exactly. Yeah. Well, I guess aside from crypto and digital assets and that,
I don't think you can associate crypto with digital assets. I think they're two completely different sources, and that's two totally different custody solutions.
Okay.
When you're looking at a digital security, you're looking at more of it would be the same thing if you lost a stock certificate. You can put in for a lost David. So on the digital asset side, those can be replaced. When you're talking about a cryptocurrency, when that's gone, that's gone.
And that's gone. Okay. Yeah. So it's not really. Yeah.
So you can't really. I don't want you to put those two in the same sentence, because those two solutions are going to be completely different. Mm. And you're seeing institutions now that are really looking into the custody side of these.
Well, that's another point. I think you might find a lot of the larger institutions looking at putting custody solutions in, for digital assets, for example.
Right. Fidelity, State Street, Northern Trust, all of these entities, these large custodian entities, they are working on those solutions. I mean, we're talking to them because that's what we're doing. Mm. So we're in conversations with these bigger players.
Frank, to be honest, I can see the difference between an ICO and a security token, for example, but the technologically, the problem of custody is the same. Is it not still a public-private key problem? Whether it's a security
it is, and you want to have. Most people are not going to want to hold their own keys, because they're just not until a solution comes around that is very easy for the end user. So it makes sense to have a third party for custodian, where you have like the double, you have the double security on your phone. If you want to go in, you want to get your private keys, you can sign stuff and do stuff by doing a security on your phone or an email or something to that nature. But there is a similarity because it is cryptographic, but the rules around the asset and the cryptocurrency are completely different.
David, are you willing to value digital assets, maybe even custody digital assets? Are you clients for those services?
Custody side, I'm not too sure we're at that, and there's to be honest, we're a European bank, so at the moment there's zero appetite for that. In terms of valuation, I mean, what we've done internally is we've centralized 3 core offices across the group that only focus on crypto in terms of valuation. And I mean, as most of these currencies per se are either on an exchange, or we use a data aggregator to take the average of 3 exchanges, and that's the price we use. So I mean, again, I think the important thing that we've alluded to, that we've talked about around valuation, particularly around digital, is that it's fully disclosed either within the PPM, or preferably, in my view, in the PPM, particularly of these asset classes, but that there's a clear pricing policy available for these asset classes. As I said, they've become a little bit more, mainstream now per se, and there's a lot more exchanges and sources that we can pull. But, I think for some of the funds that we do, and as I said, we've centralized that across 3 offices globally to make sure we have consistency, and, that we're sharing that knowledge across the group. So in answer, yes to valuations, not too sure on the custody side.
Our time is almost up, or it is up, in fact. But I'd like to address a couple of questions we've been asked before we go, and partly because one of them I think is very interesting. But let me ask you the easier one in a way first. It's from Johan de Bruyne, and he says there's a lot of discussion around AI and blockchain. Are there any technologies or services that in the peripheral view that no one is monitoring, that has the potential to disrupt us? Have any of you have better peripheral vision than anybody else, and seen something coming up which is likely to disrupt? A respectful answer to that is no. But Frank, what would be?
I'm sorry. Could you just repeat the question? I lost you for a second.
The question is, there's been a lot of discussion around AI and blockchain. Is there any other technology or any other type of service that we haven't spotted yet, none of us are monitoring, that has the potential to disrupt the fund accounting industry?
Quantum computing, when that happens, where that's going to disrupt all AI and it's going to just disrupt all distributed ledger technology. So I would have to say when quantum computing comes around, we're going to see, we're going to have a whole new realm of disruption.
Okay. Richard, do you know, can you think of anything?
No. That was a valid answer, wasn't it?
Yeah, it's a valid answer.
From a lawyer.
I think if I knew, I wouldn't tell, right? Because we want to get ahead of the curve, right? We want to, if we can foresee what would disrupt, we obviously want to be part of that disruption, right? But can't think of anything offhand.
What about those biological robots you call fund accountants?
You said you weren't going to ask that question.
Okay, here's just a last question here, because I think it's an interesting one, and one I would have asked as well, which is why we think there'll be more pressure to deliver NAVs more frequently using blockchain. The real interest in this question is, will there be new instrument types? In other words, is there a possibility that funds themselves get replaced by some other type of vehicle? Now, Richard, you could argue managed accounts are a new type of vehicle, but are you seeing your clients coming up with ever zanier ideas other than the normal fund structures?
So I think it's possible that there is that technology makes operating a series of managed accounts more feasible, rather than the sort of general desire of an investment manager to manage a single pool of assets for a particular strategy. So I think that there are several reasons. One reason why a manager will not want to manage a series of managed accounts is there's a lot of administration in splitting tickets when taking a position across a number of different accounts, and then rebalancing those positions as and when new money goes in and out of the different accounts. But given that there has been a sort of quite a long-term trend from certain investors, particularly institutional investors, to have control of their assets and not have them mixed up with other investors. This sort of, they think that will assist them if the fund gets into difficulty and wants to gate or suspend redemptions, and they can access. They'll have the liquidity of their own assets and their own asset pool. I think technology could assist in making a managed account per investor more feasible. Won't work in every strategy, but will work in many. I hear some clients talk about a sort of tokenized version of their fund, but I haven't seen it implemented as a concept to date.
Giles, do you anticipate some new instrument or some new fund structure? You've heard Richard talk there about technology making managed accounts, which managers tend not to like, but investors do, easier to manage, easier to run, easier to offer.
I kind of agree with Richard from, I guess, a structure point of view. But I think that's probably a different question from new types of securities, for example. I mean, I think there's new ones being made all the time. And I guess cryptocurrency was in a way a new one as well, right? So the next thing you might find they're creating derivatives on cryptocurrency or something around that. So from that point of view, possibly, but I don't think the vehicles necessarily that actually hold the underlying assets would necessarily change.
Frank, did you want to have a last word?
I think inevitably there'll definitely be new structures. I'm really not qualified to, or don't want to take a stab at what they'll be. So I'm going to refrain from that.
You're not a futurist then. And David, perhaps a last word from you as a last word from our sponsor, as it were, about the future of fund accounting. Are you brimful of confidence that it's going to survive, and that you're doing such a valuable job that no technology will disrupt it sufficiently to, well, technology is going to make you more and more efficient. It's not going to knock you out.
Yeah, I think that's it. I think that trend will continue. I mean, when we look back at when I think I said when I did my first NAV back in 2000, which I can't believe is 20 years ago now, we were migrating off a DOS-based system. I still laugh at, my double entry accounting was F2 and type in a number and go to the P&L and do the equivalent. So technology has played a huge part in how we've produced NAVs and how we've, streamlined operations, hold straight through processing, market data. It's really helped us improve our efficiencies and deliver, a real time or deliver an NAV to our clients. And I think that will continue. And I'm quite excited about what the future lies in terms of technology. We've just spoken today about the impact that AI, machine learning, and blockchain has had and will continue to have. And as I said, it's not really been as disruptive yet as we thought, but there's been really good examples today of how it's playing a big part in what we do and the process that we do. So I really see that continuing. And yeah, I think from us, from the Apex Group, we should be able to value it as well. So, excited about what the future from a technology point of view has for fund accounting.
Thank you, David. And I think that's where we probably need to stop. It's been a fascinating discussion, operating, I think, very much on the edge of what is possible to know. So it remains for me only to thank our panelists, Giles Sayers from Allborn and Frank from Invenium, Richard from Simmons & Simmons, and of course David Barry from Apex, who made today possible. And thank you also to our audience for your questions and your interest and your engagement with what we're doing. We will be writing this up and publishing it, and we hope that you will continue to engage with what we've raised today by those means as well. And with that, I think it's thank you and goodbye from the 5+.
Brilliant.
Bye-bye.
Thanks, everybody.
Brilliant.
Thanks.
Bye-bye, everybody.
Thanks, everybody.
Thank you, Dominic, and thank you to our panel. If you would like to see the summary of this discussion, please visit our website on www.futureoffinance.biz. And indeed, if you would like to see the video again, that is also on our website. Many thanks.